So I'll talk about stock options, and there's actually two types of stock options. One type is like company options. You work for a company can give you options. That's different, not completely different, but different from ones that people can just buy on the open market. So the concept of options really got started in 1973. So options started being offered by an exchange in Chicago called the Chicago Board of Options. And an option is basically a contract. So again, we're back to, is a contract? Okay. So I'll fix that. So an option is a contract that entitles its owner to buy or sell a security called the underlying security. It's similar to the futures that we've talked about, at a certain price, which is that, again, that agreed upon price in the future. And now this is going to get into the difference between a European and an American style option. You can buy it on or any time before a specific expiration date. So is there anything different about this and what we talked about when we were talking about futures or forwards? In a future or forward, you have to buy at the price at the future time. And the only way the forward contract would ever not be exercised would be if the price of the underlying commodity was exactly the same as the price you agreed upon. Then there's really no point in there's no point in me making you buy a share of IBM for 105 if it's currently selling for 105. We could just kind of call it off. But in this case, the difference is the person on the buying or selling side has the option to say, I don't want to buy it. Since I believe I'm going to lose money, it's my choice to buy it. So that's really the only difference between an option and a forward. So for example, let's say I was on the buying side of a forward. I would say, let's say the stock is currently selling at $100 and I agree to buy it in the future for 105. If it goes down to 42, I wouldn't want to buy it, but on a forward contract, I'd have to buy it. Right? Here I have the choice to buy it. So if it's currently selling for 42, I don't want to buy it at 105. I'm giving away money. So in this case, you have the choice to buy it. That's why it's called an option. You have the option to buy it. So it's like a futures contract, except that you have the option to say, I don't want to participate in it if it goes bad on you. Okay, so an example of an option would be, suppose IBM stock is currently selling for $81 per share. And Steve and Mary agreed to the following. Mary is required to sell 100 shares of IBM to Steve at $85, so that's our K, at $85 a share at any time that Steve wants to between now and the next 3 months. So again, this is what we're going to call an American style option. I have a slide on that shortly after this. So if that was the case where Steve can call Mary at any time and say, you must sell me the stock for $85, that would be an American style option. And then why would Mary bother to agree to this? Doesn't it sound like, if you're thinking of it from the forward and future point of view, isn't it like Steve can't lose? He can only win. If the stock price goes up to 150, he's going to call Mary and say, sell it to me for 85 like we agreed. If the stock goes below 85, he's not going to call him. So looks like only Steve can win and Mary can only lose. Why would Mary exist? And why would she be in this? So the futures contract, both people sign it and don't pay any fees. In this one, Steve would pay Mary a fee of, let's say I'm making up a price here, $2 per share, upfront, non-refundable for any reason, and would pay like $200 to have her sign on the lose-only side of the contract. So she's receiving money up front, and then in the future may or may not lose money. And she may lose a lot more than the $200 she gets. So then the question is, why does this concept exist, and why would there people be on one side? Why would there be buyers? So, for example, if you believe a stock price is going to go up very high, and you don't want to go and buy the stock because that would eat up a lot of your money, you could just pay for these small contracts, these little $2 fees, and then if the stock price goes up, you'll get the same benefit as if you own the stock. But it's not the same as owning the stock because you have to pay this upfront fee. But if the stock price does go way down, you don't lose anything.
The upfront fee, is that like the cost? I mean?
So the cost of the option?
Yeah.
Or the price of the option?
Yeah. Okay.
So really what you're doing is you're essentially paying a small fee, and that entitles you to any profit if the stock goes up. But you don't own the stock. You're just signing a contract that says, if it goes up, I'm gonna take the profit side of it. If it goes down, I'm only losing the fee that I paid, the cost of it. So it might make sense why people would be on the buying side. Why would somebody want to be on the selling side? The person on the selling side is somebody who wants to collect fees. So you collect these fees and then cross your fingers and hope that the stock doesn't go in the direction that the person who's on the other side of the contract wants to go in. So for example, if you want to buy an option that if the price went up, you get the profit part, how much it went up, you would pay an upfront fee now. The person would keep that fee, but then they would be liable for all the dollars that it went up by. If it never went up, that person collected a fee and never received a phone call from it. They're just collecting the fee. So if you believe a stock will not go up, there are going to be people out in the market who want to buy an option on it, and you'd be on the side of it that has to pay out if the stock goes up, and you collect the fee, and if the stock doesn't go up, you're collecting fees and not doing anything. Okay, so then there's two different types of options. These names aren't the greatest, as far as meaningful names, but the type of option where you have the right to buy the stock from somebody in the future. So obviously, if you wanted to buy that type of option, your hope is that the stock price will go up. So the type of option where you have the right to buy it at a specific price is called a call option. And I guess that comes from the fact that if the stock price goes up, you would end up calling the person and say, I want to invoke the contract. But then there's another type of option that says you have the right to sell the option at a specific price. So it's exactly like the futures and forwards thing we talked about, but you would be on the seller side. But it's an optional one. So in a future and forward, if you're on the selling side and the stock price went way down, you'd be forced to sell it at a high price, and you'd be on the losing side of that bet. In this case, you just say, I don't want to sell it. No, I don't want to take the big loss. Again, you're paying a fee to be on either side of the call option or the put option. The person on the other side of the bet is collecting a fee from you, and now it's kind of like you have a forward contract with them, but only you can only win or call it off, and they can only break even or be called by you. So they're collecting a fee, but then they may lose money in the future. And you could do it with the buy side or the sell side. So it's very similar as far as the forwards and futures are concerned, except that you have the option to get out of it if it goes bad for you. And what do you have to pay to have that option? You have to pay an upfront fee. And then there's many different styles of options, but the three most commonly talked about are the European option. So the European option is very much like the forward and futures, that there's a future date and the exchange is done on that date. You can't do it before or after that date. So if you agree to have this thing expire 1 year from today, it has to be acted on 1 year from today. The American style option is we have an expiration date, but the person who has the choice to buy or sell, buy if you do a call, sell if you do a put, the person who has the option, the choice to call the other side of the contract and say, I would like to invoke this contract, can do it at any time between now and the expiration. You don't have to wait until the last day. So if the stock that let's say you bought a call option, which means you're hoping the stock will go up. If the stock shot way up and you're thinking, oh, by the time the expiration comes up, it might go down, I'd like to cash in now. You can call up and cash in now. You don't have to wait till the last day. So the American style is very much like the European style, except you can call at any point between now and the end. European, you have to call at the end. The Asian style option, which makes the math very interesting, is there's a period of time, and there's rules about how we take an average of what the price was during that period of time. And then if the average was above or below a certain price, then you would receive money. This style is, does anyone see an advantage to this? The Asian style? Well, one thing, so options, if for some reason you know information like a certain stock some inside information, a certain stock may go way up or way down 3 weeks from now, some piece of news is coming. A good way to make money on that is to buy options on it, not to run out and buy the stock, because you can get a lot more shares in options because it's the small fee instead of buying the whole share. You don't have to buy a $100 IBM stock, you might just pay a $2 fee and get the profit part. So buying options is a good way to make money if you know a stock is going to start to become erratic. So some corruption is involved in buying options on stocks. The Asian style means the corruption would have to be along the whole period of time. It's very hard to make a lot of money knowing inside information. Buying an option on something that is an average over a long period of time. So one little piece of news will throw the balance off a little bit, but not a lot. It's not like Wednesday, the big piece of news hits, the price shoots way up and you immediately exercise it and get out at that point. So that style is kind of good for avoiding using options for corrupt reasons. Okay, so the payoff curves, depending on which type of option you buy. So we said that, this is a popular financial terminology, to be long means you're hoping that over time you will make money. And the call side is basically saying you have the option to buy the stock in the future. So what is your payout? So if we had a strike price, let's say a strike price of $100. Let's say there's a share of stock, and if 1 year from today, if it goes above $100, you would have the right to buy the stock for $100, which means your profit would be whatever it is above $100. So if it was currently selling for $120, you would have the right to buy it for $100. So you're buying something that's worth $120 for the price of $100. That's a profit of $20 to you. So as soon as it gets above the strike price, for every dollar that goes above the strike price, that's an extra dollar to you. But in order to be on the option side, you had to pay an upfront fee. There was some initial fee, because you're trying to get somebody to be the person who gives you money when it goes above the strike price. And to entice that person to do that, you had to pay them a fee up front. So you lost money initially, and as long as the price of the underlying stock stays below the strike, you're not going to call the person to buy the stock, because it's not worth it to call. It only becomes worth it to call them if the price goes above the strike price. So you're losing money, losing money, losing money. Then it finally crosses the strike price. So again, like in our example, if the strike price was $100, then if the stock was selling at 95, you're not going to call the person and say, I would like to buy it from you for 100, because it's only worth 95. You wouldn't bother calling the person. You would take the option to not buy it. And you lost your fee that you had to pay at the beginning. So as long as the strike price is, as long as the stock price is below the strike price, you're not making any call. After it goes above the strike price, you're going to call the person to collect your profit. But you have to make enough of a profit just to eat away the fee you paid at the beginning of this transaction. And only when the price goes up high enough that you've recovered the fee you paid, do you then start making profits. So your profits are up at this point, from this point onward. Now, the other thing is, if this was a long-term option, let's say over a period of a year, you're paying the fee at the beginning, and you're collecting the profit at the end. So now we have to take into account interest. When you paid up front, we have to figure out its future value to see whether this option in the end was worth it or not. So we would need the strike price to go up. We would need the stock price to go up high enough over the strike price to cover the original fee we paid and possibly any interest. And then at this point, it becomes profitable that we did this. So we'll definitely make the call as anytime the strike price goes, anytime the stock price goes above the strike price, we're gonna call to collect our profit. But we have to make enough of a profit to at least take away the fee we paid at the beginning. So what we're looking for when we buy a call option, so long means we're on the buying side. We're not the person collecting the fee and insuring it. We're paying the fee and then hoping it goes up. This is what our graph looks like. Okay. Oh, so this is, we were talking before, I was saying this, I was calling it the fee, you were calling it the cost.
Yeah.
I think premium is probably the official word for it,
Time
the price
premium?
you pay to get somebody to be on the side of the contract where you would get paid and they would never get paid.
The time premium, you mean? Like the cost minus the intrinsic value?
The what?
The cost of the option minus the intrinsic value? The time premium?
Yeah, that's the time premium.
Yeah.
Okay. So then we could also buy a put option. So what was the put option again? A put option is you're signing a contract saying, I have the right to sell the stock at some point in the future. So what are you hoping for? You want the price of the stock to drop because you're going to call the person up and say, you must buy this from me at this high price that we agreed upon a year ago. So you would like the price to drop because you could run out and buy it cheap and then sell it to this person at a higher price. So the price you're buying at and the price you're selling it at will determine how much your profit is. So again, since you're long, you're on the buying side of this, you paid a fee. And you paid a fee initially, and now you're hoping that for every dollar it goes below the strike price is $1 to you. So this is a line with a slope of -1. And so it ends up being like a hockey stick too. And so again, it ends up being like a hockey stick. So the option prices, the option payoff curves end up being flat in some way, which is the fee you paid. And then at a certain point, whether you go below the strike price or above the strike price, the price in your contract, whether the underlying stock goes below that or above that, it starts being money to you and it starts angling upward. So there's two different ways. It would be a line going this way and then off like that, or a line going this way and off like that. The selling side would be what? That's the person on the other side of the contract. So if two people agree to some contract, if you had the profit curve for one of them, and there's no money being made or lost, it's just people exchanging money, what would their curve have to look like? It would have to be, a mirror image of it. So it'd be so they would be collecting money, and then if the price went above a strike price or below it, then they'd start losing money. So their curve would end up should be the opposite. So if they are the person signing the contract and willing to take a huge loss if the price went, to one extreme or the other, they are then collecting a fee, so they're making a profit, so this would be somebody who is on the selling side of a call option. That's the person who collects the fee from you, but then they are on the hook in case the price goes up. As the price goes up, they're forced to buy the stock from you. So for example, if the stock went up to $200, they were forced to buy it from you for 105, even though, like, if the price goes up, they would lose money. So if the price went up, they would be forced to sell it to you for 105, even though it's currently costing 200 in the market. They'd be losing 95 a share. So their payoff curve is profit, 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 whatever the original fee is or premium. And then once it goes on the calling side, once it goes above the strike price, once the underlying stock goes above the strike price, they start losing $1 for every dollar it goes above that. So they're still ahead even if it came down to this point, or they'd be breaking even if it came down to this point. So if let's say, for example, this would be a calculation with no interest. Let's say they collected $10 per share from you at the beginning of the contract, and then the stock price was $10 higher than the strike price at the end of at expiration. They would have basically given you back the fee they collected from you originally. You'd both break even. So where the line crosses zero, that's the break-even point for both parties. And then the other one is the mirror image of the long put. So this is a person selling a put option, not buying a put option. So selling a put option is they're collecting a fee from you, and as long as the stock price stays above the strike price, you're not going to call them, so they're just collecting this fee. And then what ends up happening is, if the stock price does drop below the strike price for every dollar it drops, this person ends up being on the hook for paying out $1. And that could go all the way down to if the stock price hits zero. So being the seller of a put, you are still theoretically capped at how much you could lose. If the stock price went down to zero, your loss would be, you would gain the premium but then lose the entire, everything below the strike price, okay? So if you had a strike price of 100, for example, and you collected a $10 premium to be the person on the hook for taking a loss, you collected $10, if the stock price went to zero, you would owe $90. You would owe $100, which means you collected 10 and lost 100, so your loss is capped at 90. But the one the other way, where you're the short call side, you're collecting a fee, but for every dollar the underlying stock goes above the strike, that's $1 loss to you. That theoretically could go off to infinity. You could take an infinite loss. The stock price would have to go off to infinity. No stock price ever goes to infinity, but theoretically it could.
Wait, if you're short a put, that means you're bullish, right?
If you're short a put, so short means you're collecting a fee, but you're on the hook to take a loss. That's the short side of either one. A put option gives the person the ability to sell the stock to you at a fixed price, a price you agreed on at the beginning. So, like, let's say you and I had an agreement, you have to buy stock from me for $100. If that stock starts going down, you're not gonna wanna buy it from me, but you signed a contract that you have to buy it from me. So I would sell it to you for 100, even though it's worth 50. I could actually buy it for 50, sell it to you for 100, and I'm making 50 a share. And now you're buying stock for 100, that's really only worth 50, so you're losing $50. So the 50 I'm gaining is the 50 you're losing. So put options, the put option increases in value as the stock price goes below the strike. Calls increase in value as it goes above the strike. And then, like always, every contract, there's two people on each side of the contract. If we did a forward, there would be no premium. We would both just sign a contract at the beginning, and then I would be hoping the price would drop and you'd be hoping the price would go up. An option means one person collects a premium from the other, and then you can either lose or break even, you can't win. So you're winning in the sense that you're collecting the premium, and that puts you in the place where you no longer have the win or lose. So there's not a whole lot of difference between forwards and options. If you remember, a forward had a curve like this, a straight line like this, meaning you could lose or you could win. And the other person did the opposite of you. An option says a premium comes in and you can win, or at a certain point then just break even. So there's no losing side to it, but the losing part is the premium that got introduced. So you're definitely going to lose in the paying the premium part, but that mitigates your ability to take a massive loss. So it's almost, you could think of it as paying an insurance policy against a loss. It's like you're buying a future contract and then paying insurance, an additional insurance fee to make sure you don't take a big loss on it. But when you buy insurance, you always lose the insurance bill you pay. So it's kind of like that. An option is a lot like a future or forward, but you're buying an insurance policy so you don't get on the losing side. But now that you're paying this insurance premium, you're definitely going to lose something. So you're paying a fee to avoid a big loss. Okay. So then there's this concept of what a put and call price should be. Or again, this goes back to the arbitrage argument, that if the price of the premium on a put and the premium on a call for the same strike price should have some connection to each other. And this is an argument that says their connection has a formula to it. So consider this. Consider two investors. Investor A has one European call with a strike price of K. They currently own that. So they obviously paid some fee to get that, right? Because they're on the call side. Okay. And they also have an amount of money, K e to the R of T. I think I have an example on the next slide, so I think this usually works better with examples, that they can put in the bank. So think of this like this. Let's say we had a strike price in the future of 105 for an underlying stock. Let's say we had a stock. So the person is going to get, if the underlying stock goes above 105, for every dollar goes above 105, they gain $1 from this part of their investment. They also have the strike price 105 with interest subtracted back, and let's say the interest rate is 5%. They have $100 to put in the bank, and they also have this option which gives them everything above 105 that the stock does. How much money would this person have 1 year from now? Investor A. Now let me see if the example. Yeah, so, no. Yeah, let me go back. The example, yeah, so in a case like this is just like an arbitrage argument. The argument basically is this. The position of investor A and the position of investor B are exactly the same, so therefore the cost to become investor A and the cost to become investor B should be the same, right? Because you're getting the same exact payoff. So when we take two investments and then we draw its payoff curve, all we're doing is adding the two curves together to make a third curve, right? So what would this payoff curve of the first person be? If the person, let's say for example, the strike price is 105, and that means they have 105 minus interest, 1 year's worth of interest, let's say $100 to put in the bank. So person A puts $100 in the bank, which means a year from now they're going to have 105 in the bank. And if the underlying stock goes anything above 105, they'll get an extra dollar for every dollar goes above 105. How much money would they have a year from now? They'll have 105, the money in the bank, plus anything that the underlying stock went above 105. So they're going to have a minimum 105, plus possibly more money. Now let's look at investor B. Investor B has a European put with a strike price of K. And 1 share of the underlying stock. How much money will they have in the future? So what happens with a put? If the price goes below 105, they're gonna lose a dollar for dollar for every dollar it goes below 105. And they have the stock itself. I'm sorry. They're buying a put. Every dollar it goes below the strike, they win a dollar back. Sorry about that. Okay. So for every dollar it goes below, in this example, 105, they lose a dollar because the stock is going down, but they gain a dollar because they have a put option, so they'll cancel each other out. So if the stock price goes below 105, they stay at 105. Right? They're losing money with the stock and gaining the dollar. Every dollar they lose with the stock, they gain a dollar with the put option. So they stay frozen at 105. If the stock goes above K, 105, what would happen? They own the share, so they would pick up $1. So investor A and investor B have exactly the same. 1 year from today, investor A and investor B will have exactly the same amount of money, right? They got there using two different investment strategies. One bought a call option and put money in the bank, and one bought a put option and took money and bought the stock. But 1 year from today, these two investors will have exactly the same amount of money. So the amount of money they paid today to get into their current situation should be the same. If they're not, then there's an opportunity for you to do the reverse of one of these and put the money in the other, and then you'll have guaranteed winnings. And that's not normal in a market. A window like that shouldn't exist. It's possible it'll come up, but then people will start making those investments, and then that gap will go away. So the idea of how much money would you have to pay to get into this situation and how much money would you have to pay to get into this situation, those two amounts should be the same. Otherwise there's something fishy about your market. So notice both investors will have the same amount of money 1 year from today. They will either have a minimum of the strike price, 105, or if the stock price went above that, they'd have that much. Let's say it went to 115, that both of these investors would have 115. If the stock price went down below 105, they'd get stuck at 105. They'd stay at 105. So how much money does it cost to become each one of these investors? Well, the investor A bought a call, so they had to pay a premium. We'll call that C, the amount of money they paid. And they put, let's say $100 in the bank. They put K in the future interest rate, subtracting off interest to get the present value. They put this much money in the bank and bought a call. So their total cost was the cost of the call and how much money they had to put in the bank. What did investor B have to do? Investor B bought a put option, so they also paid a premium, and the call and the put for the same K don't necessarily have to match. So they paid the premium for the put option, and then they also had to pay cash for one share of stock. And I'm calling this is stock at time 0. That means at today's time. Okay, so this relationship is called the put-call parity. So that formula should, but doesn't always hold for put and call options. So here's an example of the put-call parity. So suppose, for example, for a stock like IBM, it's currently selling for $100 a share, and a call option is selling for $110.25, and the time is 1 year from now, and let's say the premium to buy this option is $10. So just a recap of what we talked about before. You're paying $10 now to have the ability to make any, if IBM stock goes anything above 110.25 a year from now, every dollar that goes above that is $1 to you. So you needed to go to at least 121.25 just to get your $10 back, and then everything above that would make it sensible for you to have done this. And then there's actually an interest rate involved. So you have to also make enough to cover the interest rate you're losing on the $10 you're paying. Okay, with these numbers, what would the price of a put option be? So I took that formula from before, which basically said P plus S0, and I put the minus S0 on this side, and now I have the price of the call, the amount of money the person A would have had to put into the bank, minus the stock price now. And this would tell us that the price of the call would be $15. So, I'm sorry, the price of the put would be $15. If the call is 10, and the stock is currently selling, the stock is currently selling at 110.25, then 110.25 minus a year's worth of interest is 105, so that investor A would have to put 105 in the bank. And then, so investor A is paying $10 plus putting 105 in the bank. 1 year from now, investor A would have 105 or everything above 110. No, I'm sorry, the 105 would become 110 and a quarter. So 105 plus 5% interest would become 110 and a quarter. And then if this underlying stock went above 110 and a quarter, we'd get that much more money. And then we'd have to subtract 100, which is the current price of the stock, and that will tell us what the current price of the put option will be. So if you go on the internet and start and pick, you can go on the internet and look for call and put prices, and you'll also know the current price of the stock, so you could calculate what is the implied interest rate. Does that make sense? So we can actually look at, based on the markets for the options, we could look at what the we could look at what the P and C are, the current stock price is, and based on that, we could calculate what the implied interest rate is for the put-call combination, yeah?
T is the expiration of.
Yeah, T is time.
So like it's like if the call option was only good for 3 months, it'll be like.
Yeah, it'll be one quarter.
Okay.
Yeah, it would be 1 quarter of a year. So if T is measured in years, then it would be 1 quarter of a year.
I have another question.
Yeah.
Also for call parity, can't you, instead of using K, can't you use like the bond price for yeah, like the current price of like the company's bond?
For
In place of K to
the strike price?
yeah.
The price that bonds are selling at?
Yeah, cause
Let's see if,
cause in undergrad we did that too with the formula you gave us,
right.
but I remember I remember reading about it and doing problems on it that you could actually do with the bond price too.
Let's see. This is a website, there's a bunch of websites that give, financial data. There's one called freerealtime.com, but there's a bunch, there's Yahoo Finance and Google Finance. I mean, there's tons of sites that do this. But, curious. Let's see. Let's see what IBM's option prices are. Just want to see if there's any mention of the bond prices. So for example, I'm beating this IBM example to death. I keep using that. That's like a popular textbooks. Either use XYZ, company XYZ, or IBM. But so for example, what this is saying, this is the closing prices as of September 17, 2011. When is that?
Saturday?
Today's the 21st.
Yeah, Saturday.
Saturday. Okay.
So they expired already?
No, they expire on the Friday. Options expire on the third Friday of the month. Did they expire? No, it'll be this coming Friday. So, so for example, this is saying, like, what is IBM currently selling at? Is it the stock price? Is it further down in the chart? Oh, 172. 172. So where is 172? Oh, okay, it's where it changes colors. Okay, so IBM is currently selling, see where it says it here? 172 and 14. So that's the last trade that went through was at 172 and 14. And these are option prices for what month? These are September's. Okay, so you see up here, I could pick September, October, November, December. So options expire monthly, and they always expire on the third Friday of the month. So that would be next week. So the September options, which expire this coming Friday in 2 days. You might see some wild prices here. So if you want an option, so IBM is currently selling for 172 point something. If you want an option on 175, meaning between now and Friday, you'll get $1 for every dollar goes above 175. The fee you'd have to pay right now is $2.28. So you could today, or before the market opens tomorrow morning, you could pay $2.28, pay that right now, and by Friday, if IBM stock goes anything above 175 is $1 to you. So if the stock goes to 180 by Friday, you would pay $2.28 right now, and you'd get $5 on Friday for a profit of 278. 272, right? 72, okay. If oh, no, sorry, that's on the put side, right? Because what's not making sense is, yeah, sorry, the right is the put side. The left is the call side. So, yeah, I started looking, these numbers should have gone backwards. Okay, so let me state this again, so this is real data. It would cost you 2 cents to buy a call option. You pay 2 cents today, and by Friday, you get everything above 175. Now, there's only 2 days left, so it's not very likely it's gonna go above 175. But you pay 2 cents today, and if it hit 185 by Friday, you'd make $10 for betting 2 cents today. So these numbers look a little strange because they expire in 2 days. This was the put side. If you pay $2.28 today, you would get everything the stock goes below 175, and it's currently, how far below 175 right now? It's 170, it's 172.14. So it's currently $2.80 below. These prices can't be right now.
I think the 16th was the third Friday, because it was the 2nd, the 9th, and the 16th would be the Fridays
Oh,
in
okay.
September. Does that make sense?
Okay, yes, because this wouldn't make sense. You pay $2.28, you're already $2.86 in the money. You're already ahead. The second you make the purchase, you're ahead. And these are American prices, so you could immediately say, I want my money. So those couldn't be the right prices. So it should definitely be less than $2.28. Let me go to a month from now. Let me go to the October ones. Hopefully these prices make more sense. So IBM's options a month from now, And they're not always done in $5 blocks. If the price is much smaller, they'll do them in $1 blocks, but it's like whatever makes the most sense. So, hopefully these prices seem to make a little bit more sense. So, if you want to take everything above 175, now this would expire the third Friday of October, so you have a month to make some money on this. If you paid $515 is what the sellers want, $490 is what the buyers want, and $5 is the last one to go through. Ask, bid, and last. So the last one to go through is this one, the $515. So the last one that went through the options market was $515. So you could have paid by 4 o'clock today when the market closed, you could have paid $515 today, and then every dollar IBM is above 175 by next month is $1 gain to you. So it's got to hit 180 and 15 just for you to get your $5 back. Then everything above 180 and 15 would be pure profit to you. And you only have a month to do this. So what if you had more time? What if you weren't looking at the October options, you were looking at the November, Decembers? What would you expect this price to be for an October 175? So it's an October option with a strike price of 175. If the October one costs $5.15, which gives you 1 month to get above 175, what do you think you'd have to pay as a fee to be given 2 months to get above 175? More, yeah. What would you guess if you had there's no right formula, but but it should make sense you should pay more, because you have more time to make money. And the person collecting the fee from you is more likely you're going to clean them out. So they're gonna want more money. But if you had to just guess, what do you think the November 175 is? What do you think an extra month of time is worth to the person who's putting themselves on the hook by signing the other side of your contract?
It's worth more?
You think $10?
It's supposed to be more than double? It should be more than double, right?
More than double for an extra, because the time is doubled, the
Should be
price should double? Anyone just want to guess?
Like seven more, 650.
Less than double though. More, obviously more than 515, but less than 10, would you say?
Yeah, like
For the
650.
extra month?
Yes.
Let's see what a November is. Whoa, $7. That was a good guess. So for an extra $1, $5.15 to $6.90, for an extra $1.80, you're buying another month's worth of time. So there's a lot of choices for you to buy, right? Because it goes on, I think they go out a whole year for every company, and the options board keeps printing up more contracts for every company. So it's every company has, for every month, and then also for every interval, right? IBM goes from, how low do these go? They don't really start selling until the 145s. There's no market below 140. There's no market. There's nobody on the buying or selling. Well, one side just doesn't want to take on that kind of risk.
In October, there was somebody at like 130.
At 130?
Yeah.
Oh, sorry.
120, 125.
115. So you're paying, so just for
But
example.
you're paying 12
Oh,
cents.
this is October, so you're paying almost $50 today.
No, aren't you on the other side?
Outside is
You're on that side. Oh, no, yeah.
On the call side. So the yellow ones, the one shaded yellow, mean you're gonna receive money. If time ran out today, you would receive money. The white ones need the price to go up for you to receive money. So you could pay $49.45 today, and then you get whatever the stock is by next month. You get everything above 115. So if it ended right now, 172 minus 115 is like 55. That can't be right. You get everything above 115. It's currently selling for 170, so you're 57 ahead right now. That can't be right. Because this is saying you could pay $49 today,
Yeah.
and then because it's an American style option, immediately sell it and
Yeah.
collect $55. That can't be right. This number should be a lot, not more than 55. You should be like paying 58 to get like 60 or something. So you'd be paying like 60 today, and then you're gonna get 55 plus or minus the change of the next month. And that's kind of fair. There's something wrong with that price. If this was true, you could make $6 immediately. Just pay out $49, immediately collect 55, and you're done. So, okay.